Good morning, ladies and gentlemen. I hope you are well. Yes, risk management. What is it? How can you understand risk management? Because it's something that is massive in the game of trading. But I'm going to tell you now, the only way that you can truly understand risk management is if you apply it to the way you relate to risk management. In other words, what is your approach to money? Are you the kind of person that will go out for a weekend, meet up with your friends, family, go to a bar, pay $100, $200, $300 for the rounds of drinks, okay? Are you the kind of person that will go and buy $1,000 jacket, £200 shoes? What are you like with money? Because the sooner you come to understand what you're like with money, you're going to have a better idea of how much you're going to risk when it comes to trading. You lose $300 on a trade, you kind of feel like shit, but you won't think twice to spend $300 on a night out. Why? Because you're seeing benefit. You see, the problem with today's society is this. When we exchange something of value, we expect something in return. Yet when it comes to trading, we come to the charts with the belief that if we put money down, we're going to take money out. That's not the case. So there's a bit of a paradigm shift here, ladies and gentlemen. We need to make sure that when we come to the charts, that we manage our expectations of how we react to loss. There is no mathematical formula that is going to say, apply 1%, 2%, 3% risk management on your trading, which is going to take into consideration the idea of you being okay with loss. You see, before you can mathematically apply risk management, you have to understand if you can accept the psychological impact of that risk management. They don't tell you about the psychology of risk management. They tell you, if you want to keep in the game of trading, stick to risk management, because they assume that you know already what you need to do when it comes to risk management. It's simple, isn't it? Allocate your amount of risk, go to the charts, place your trade, and if it comes to a certain point in your chart that sits with your risk management, you have to let that zone hit so that you can then start again. Keeping your losses short, cut your losses short, let your profits run. Yes, it's easily said than done, because whilst you are waiting to work out if price is going to hit your stop or not, you are going through a madness of emotions in your mind where you are saying to yourself, fuck, I don't want to lose this money. I can't lose this money. Oh man, I just lost $300. What could have I done with that $300? Shit, I need to get some money in, man. I need to pay back this guy. Oh, I need to get this payment for the rent. I need to do this. There is so many motivations behind why people need to make money. And it's clouded and their judgment is flawed if they come to the game of trading when they think they are using the right risk management. And even if you do use the right risk management, there will be times where you will be challenged mentally because you don't like the idea of always having to close trades because you're sticking to your risk management. It's one of those taboo instances, ladies and gentlemen, where you say to yourself, I'm going to stick to 2% loss every single time. And maybe you hit your loss all the time. You start hitting 2% all the time and you notice your account is depleting. And then before you know it, you've gone from a $100,000 account, for example, and now you're down to $50,000, but you stuck to a 2% rule. How on earth is that going to happen? What's going on there? So where does the math come into it? I've stuck to 50%. I've stuck to 2%. Now I'm down to 50K. I have religiously stayed at 2%. What do I need to change? Do I need to increase it so that I don't get stopped out as often? What if I increase it and it makes it worse for me? This is where proficiency comes into play, ladies and gentlemen. And hopefully by the end of this video, you're going to have a sound understanding of what to do when it comes to working out if your risk management is on par with the way you actually have, or should I say, the way you approach your relationship with money. So let's dive into the charts. So you may have seen this in a previous stream and the masterclass session, where I've spoken to you about the idea of taking a certain amount of money and breaking it down so that it's manageable for you when it comes to establishing risk. You see, when you want to work with risk purely on percentages, all right, there's something that you've got to keep in mind. Take this, for example, 10% of your capital. Well, what is 10% to you? How do you feel about 10%? Nah, man, that's too much, man. Fucking hell, I don't know you'd look at that. No way. Well, it's what you do with this 10% that's going to make sense. So let's say you have a 10K account. 10% of 10,000 is 1,000. Now we've got 10%. Cool. Does that mean you risk 10% on your trade? Because 10 trades later, you wiped out. There is a theory called risk to ruin, and that's based on how many trades is it going to take for you to blow your account. Now, there was an instance in my trading where my risk to ruin was about 85%. So there was an 85% chance that I was going to ruin my account. I was going to lose. And I was going to blow up my account. And that was very demoralizing for me. Because statistically it said that based on my behavior of trading, I would lose my account 85% of the time. That's when I started to realize that I needed to lose less. I was losing more. I needed to lose less. Then that risk to ruin ratio started to drop. It went down to 50%. And it went down to 30%. Then we're rolling in and around the between 9 and 12% chance of risk to ruin. Sometimes it depends on what I'm doing. My risk to ruin could increase to about 20-21%. Why? Because I put the house down. I'm that guy that has a very high risk factor. Because that's the whole point of the hybrid, is to go into the trade on the idea that you have caught the move, not the top, not the bottom, the move. And with your understanding of the hybrid system based on how often you sit and watch the charts and expose yourself to learning about the charts is going to be reflected in your risk to ruin. Okay? You see, what you've got to understand is this, ladies and gentlemen. Okay? When you're trying to work out where price is going to go next, you need to say to yourself, well, how comfortable am I putting the house down? Now, what do I mean by putting the house down? I use it as a figure of speech to say I'm using quite a bit of risk here. Okay? Now, what does risk mean? What is risk? Yeah, what am I using it on? $50,000 account? $150,000 account? If I take 10% of $150,000, that's 15K. If I take 10% of that, that's 1,500. If I take another 10% of that, that is 150. At that point in time, whatever it is that I decide to put down, I have to be comfortable with the fluctuations. I have to be rewarding of those fluctuations in the sense that if price goes in my favor and I realize a return, am I happy with that return? You see, that's the thing with risk management. If you're going to use 25% of $1,000, that leads to $250. And then you use 25% of that $250, that's $62.50. Well, let's face it. If you go in at 100x and you only use $62, quite frankly, ladies and gentlemen, that's a small amount of risk. Okay? What are the fluctuations? 100% doubles your money. Happy days. Are you cool with $124? Are you cool with that? Is that enough for you in your day-to-day? Do you get caught up in the idea that you've seen people posting mad gains on the Discord or mad gains across the realm of cryptocurrency? The only way that you can actually get yourself in tune with your risk management is if you close off any idea of anyone else making money. Naturally, there will always be someone that has more money to put down. That is the truth. And the sooner you come to accept that, the less likely you're going to be inclined to start risking more money so that you can match up with that person's returns on their trade. You see, when you're only looking for like a $200 to $400 move in Bitcoin, what is that value to you? Are you going to earn 10 cents after $200? Are you going to earn 50 cents, $50, $200, $800, $1,000, $10,000? Ultimately, you have to get into your mind and say to yourself, I need to disconnect from the idea of making money whilst focusing on making money. It's one of those catch-22s. Okay? Some people come to the game of trading like me, where at the first instance, I was obsessed with the amount of money that I made and obsessed with the amount of money that I lost. Then I started transitioning into being obsessed with the idea that the trade didn't play out. I moved from focusing on what money I needed to make and what money that I had lost, and started focusing more on the idea of the accuracy of my entry. And it was that transition where I focused more on the accuracy of the entry, which would then let the trade look after itself in terms of the wins. You see, if you focus on the accuracy of entries, then you'll know that the end result is going to be money. So why on earth would you be caring about how much money you made if your goal is to become proficient in the hybrid system? Proficiency doesn't mean you're making money. Proficiency means you understand how it operates. Because the end result is money. Take a machine. Its sole principle is to create an end result. Now, the machine has been programmed with algorithms, by manpower, and when it's applied optimally, it's going to provide the end result. Okay? The machine hasn't got time to be thinking about, well, what if the end result isn't as good as what it needs to be? That is down to the human aspect. And that's the issue with trading. People come to a chart and they say that once I place a trade and I expect price to go from here to end up here, how much money am I going to make on that move? I'm going to make $500. Yeah, man, that's cool with that. Oh, shit. But what about if Bitcoin takes too long to move up to there? What if it goes down further and I'm losing money? What if I cut my loss so short? Okay, and then I witness price go all the way up. Ladies and gentlemen, the hard truth of trading is this. You will never know exactly if price is going to go up or down at a certain point in time. You will always have to factor the idea that it can go up before it goes down. It can go up before, and it can go down before it goes up. Okay, some people in the channel always like to say sly comments and say, yeah, so Bitcoin up or Bitcoin down. It's always the same thing. Unfortunately, that's exactly what it is. Bitcoin does go up and Bitcoin does go down. And if people are struggling with that concept, they ain't going to get the game. Okay? Your goal as traders is to make sure that the liquidity that you do use to in essence project your desire of an outcome being positive or negative, it's how you act after the objective has been complete, which is going to reflect whether or not you're going to continue to sustain that mindset. In other words, if you see price go up in your favor and you made $500, happy days. You need to ask yourself, what do you have to do in your everyday to make $500? Do you understand what times we are living in, ladies and gentlemen? It's a very difficult time in the world. It's sad days. The effort that people have to go to for an hour's work is phenomenal. If you earn $10, $12, $15 an hour, what do you have to do in that hour to earn that? What shit do you have to take? Where do you have to travel? What do you have to understand? What is expected of you so that in that whole hour you pick up that $15 that the company is obligated to provide based on your commitment to fulfilling that obligation? What is it? When you make $500 and you make it within an hour, if your existing role or in your existing employment or whatever it is that you have as a business, if you can earn exactly the same amount of money in your existing business and it's already continuously happening and you've got the consistency of it, why on earth are you trading? Why would you put pressure on yourself to force liquidity out of the marketplace? Now, if you are coming to trading because you fancy a career change, fine, that is acceptable. If money is not an issue for you, then coming into trading, you want to challenge yourself. That is welcomed. There is no problem with that, ladies and gentlemen. That's cool. But there are people that are trying to come into the game of trading because they need capital, they need liquidity. We have to accept that this is the truth. And that's why people lose in trading, because they come into the idea of how much money they can make. What's the end goal? How much mullah can I pull out of the market? They start projecting out what life would be like with more money. And I'm sorry to say it to you, ladies and gentlemen, but you have to get rid of money in your mind if you're going to try and make money in trading. You can't be married to the idea that you have to make money in trading. No. Money is the end result. So what is it that we need to focus on to help us actually come up on top so that we can make money and not worry about making it and worry about how much we are risking? A business owner will know that they take a risk every day when they open their shop. The risk of no customers coming in, the risk of having to pay the staff even though there are no customers, the risk of having to pay for the rent, the risk of having to pay for the mortgage, the risk of having to pay salaries, pay your suppliers. If no customers are coming in to pick up the green jumpers, ladies and gentlemen, you ain't gonna have capital for you to operate your business. That is something that a business owner will always have in the back of his mind. Will he get a transaction? But in trading, it's a little bit different. You can't force a transaction. You can't force a win. The same way you can't force a customer to come into your shop. Now, you can sway a customer by means of by means of marketing. You can put an advertisement out there. You can run an offer. You can say, okay, try before you buy kind of story. Get people interested in what it is that you have to offer. Okay? And there's always going to be an end result to that. If it appeals to someone, happy days. You can't come to the marketplace and say, hey, Mr. Market Maker, I really would like to make £500 today. Is there any way that I can entice you into, giving me your liquidity so that I can actually see a return on my investment? Because I'm really good at risk management, man. I've been trading for about 6 months now, and I've been watching the way price moves. I know I love the way that you hit the price to the upside, to the downside. That's fucking awesome, man. I really enjoy that. No. Unfortunately, that's not what this is about. You see, the market maker, if we were to consider it as a business, okay, is a loan shark. That's what the market maker is. He gives you money. If you don't give it back with interest, he's going to make you pay. Okay? How does he make you pay? He'll hit your liquidation. Okay? He will hit your liquidation. If you are not aware and prepared to pay yourself, before we can focus on how much money we can make, we have to get into the habit of taking it when we make it. Paying yourselves is an important factor, ladies and gentlemen. And you hear me talk about it all the time. Let me do something with you. Okay. So what is this you're doing, Tino? What on earth are you doing? Why are you looking at poker right now? Because I'm going to help you understand how to apply risk management. Okay? In the game of poker, the whole objective is that you represent your cards as more strength to the opposite player. Okay? So watch this. Let's assume that I have got 6 players against me. I currently have a high chance card. This is a King 10 suit. I'm going to call this for the nature of demonstration. I technically have a good hand, but I know I've got other hands that could actually compromise my existing hand. This guy, he bets into me. I've got $10 here. Okay? The blinds themselves, all right, are 5 cent, 10 cents. So I've got lots of capital. Now I can call this to see if he's representing a queen. I'll call it. Now I have the king. He's now scared. He bets into me with a low amount. Is he going to try and lure me into it? I need to understand if he does have the card. Move up a little bit more. What's the pot? The pot's 76 cents. I'm going to bet 40% of that. 4 times what he has put in. Is he going to call? No, he's not going to call. Okay? What I'm trying to get at with you in relation to this game, and what I just did there is, he gave me information. Now look at this information. He's gone in aggressively. Okay, it's a different player because this is Zoom, because it changes all the time. Okay, he's raised 2.5 times the initial amount for me to actually call. So, based on the strength of these cards, do I call it? Well, it all depends on what kind of trader I am, poker player I am. If I call it, I'm playing a marginal hand. Let's call it. So I call it. It's now me and him. The deck shows that I've got dog shit hands, okay? It's on me to decide what happens. Do I want to risk more money or do I want to see a free hand? I'll see a free hand. Cool. What's he going to do? He's going to start putting money in because he wants to scare me off. He's betted with the same amount that he started with. He's bet 50% of the pot. Now, do I want to start burning my liquidity? Do I want to start holding on to this hand because I believe that if I do actually call, I'm going to actually see a return? No. So I'm going to get out of this hand. Okay? Let's assume that we have got everything set up in our favor, ladies and gentlemen, and that we actually do have an opportunity where confluences all come together. Now, in poker, it's going to be a little bit different, but I'm going to bet as if I do have the good hand. So I'm going to bet 30 cents. I'm going to make these guys believe... Okay, maybe not. I need to wait and see if I can get myself a good hand. Okay. Let me wait. Let me do this. Hold on. Okay. So here's a great hand. Okay. He has raised, all right, nearly 10 times the pot size. I've got a great hand. I'm going to call it, okay? Because I have the best hand. Other than aces, I've got a very good hand. So everything has gone in my favor. The board is shit, and I've got a pair of kings. He's shoved in with aces. He's shoved in quite a bit at the start. I have to call or re-raise to pay to play. I want to know what he has. So I'll re-raise him. Twice the amount. Is he going to call? He's called. Now we've got a flush draw. Now my great hand at the start is acting like a bit of a problem now because all he needs is two other cards which match up as diamonds. But he led out to me first. So I'm now going to pay to play. So I'm going to bet 50% of the pot, which takes off quite a bit of my capital. We are now going to go all in. He's called all in. He now has either a pair of aces, okay, or he's got a flush draw. Is he going to try and save his hand? Let's see. We pay to play. Oh, he's got the diamond. Will the diamond play out? Cash out. I obviously won. He loses. Oh, we split the pot. We won a straight. Forgive me. But do you see what happened there, ladies and gentlemen? I had the best hand pre-flop. So if we both had our cards open, he only needed an ace to win. Okay? And if the ace didn't hit, I would have seen the success of the actual card. Okay? But the board texture itself kind of screwed me over because there was a straight draw. So what's the lesson in all of this, ladies and gentlemen? I'll tell you now. Notice the thinking behind why I decided to call his cards. Notice the betting patterns. Notice the aggression. Notice the fact that at the start of the actual hand itself, I had technically one of the best hands. Other than a pair of aces, at the start, I had the best hand. So I go in with the idea that I'm going to get paid out on this. Correlate that over to trading. You've got all the confluences in your favor. It would say that price is going to move up in your favor, ladies and gentlemen, because price is above the 50 EMA. Price is above the 200 EMA. You've got the psychological high acting as support. You've got vector candles to the left side of the chart. You then decide to risk the capital. You then say, okay, I'm going to risk X amount of liquidity. I'm going to only take 10% of my initial investment or 8%, and I'm going to put it into the chart to see if it's going to work out. even though all the confluences have come together to say that this is going to go up. You never know exactly it's going to go up, but in line with the system that you are using, the hybrid says that price should go up based on you understanding the structure of what's going on. Now you can see there were many variables that could have gone against me, but also variables that could have gone in my favor. The one thing that you need to keep in your mind, ladies and gentlemen, is variance. You can have the best hand in poker and still lose, and you can have the best hand in poker and break even, because that's exactly what had happened. You see, the best hand was on the deck on the turn. There was a straight. Now I've got a pair of kings. He's got ace king. He didn't even have anything. He went in with ace king high. I had the best hand at the start of the game. One of the best hands at the start of the hand, and the board texture was fantastic. Now, if we start considering what other cards could have beaten me, yeah, that's going to be part of the parcel. There were 3 more aces out there that could have happened. There could have been another diamond out there that could have taken me out because I didn't have a diamond to match up with a flush. Okay? What I'm trying to say to you, ladies and gentlemen, even if you do have the right risk management, and you notice at that point in time, I was only playing with $10, but look at the betting sizes. Look at how aggressive he was at the start of the game. He already told me that he was going to be shoving his hand at some point and hope for the best. That sort of thinking in trading is going to be exactly the same. You can assume that price is going to go higher, okay? And you then start putting down more size because you believe at that point, that's when it's going to move up. But in trading, what if it does this wicked movement up and down, and shakes you out before it actually makes the move? You see, ladies and gentlemen, in terms of trading itself, what you've got to be aware of is if you have a zone where price is moving up and down in, okay? Are you going to be comfortable trading this? How often is your risk management going to be challenged? How often are you going to say, oh man, it's going up, happy days. Oh shit, it's going down. Oh man, it's going up. Oh man, I don't like this. Is it going to break it down lower? Oh God. Oh, what if it does that? And then bang, it decides to break down lower. And then you're saying to yourself, oh no, my risk is there. I mean, if I let the trade go against me, this area here, this line right here is where I will get out and I will lose 8%. Oh, how can I make back 8%? Oh man, I don't know about that. Maybe I need to give it a little bit of room. Let me just move this down a little bit. I mean, the confluences are all working in my favor. I mean, it's only going to go up from here. It has to go up from here. Look, price at this point last night, if you remember from the video, you know, if you had taken that trade, you would have seen a minimal drawdown at this point in time. If you had gone long from that point right there, and you would have seen success in that move to the upside, even if you just took it, you would have not had any drawdown on here. If you had have gone long on here, yeah, you may have seen a little bit of deviation, but come on, man, a $10, $20, $50 move on Bitcoin as a deviation against your entry, that is brilliant, because you then would have made a stack on the move back up. And of course, the retrace back into the vector candles, it worked out well at that point in time. You see, at that point in time, is your risk management going to factor in the volatility? Because that's what it's all down to, ladies and gentlemen. Risk management is factoring in, are you going to have the right amount of capital that you can sit and absorb the deviations away from certain points? Can you withstand this sort of behavior? You see, why does this happen in the charts? Because this is where people are trying to find out if this is the low or if this is going to be the move that's going to send price in one direction against the next. Are you going to go short on this candle? What kind of confirmation are you going to put? Do you believe it's going to go in your favor to the downside? Because it does go to the downside, but then it also comes back up. When you pay yourself, okay, that's when you get your proof of move. When you've paid yourself. The longer you keep your capital exposed in the chart, the less likely you're going to understand if the move is going to be favorable for you. If you're sitting in a trade and it's not moving in your direction, why are you waiting for it to go against you? If it's not going in the direction that you want it to, why are you waiting for it to go against you? Ask yourself that question the next time you open a trade and it doesn't go in the direction that you want it to. If it starts working its way down and down, ask yourself the question, well, how long have I been in this trade for? If you're a swing trader, different story. You're going to have to factor in the time frame that you swing trade from. So if you are a swing trader where you hold trades for about 3 to 4 days and you are 6 days into your trade and you're still holding it and price hasn't gone anywhere, you really need to say to yourself, well, what am I doing in this trade right now? You need to close the trade. Because when you close the trade, you'll have a much more better perspective on how likely it's going to go into a move to play out in your favor. And then if it does decide to play out in your favor, even as a swing trader, you're still going to have plenty of time. You see, if you weren't long in this area here, for example, ladies and gentlemen, as a swing trader, and you're looking for movement to the upside, okay, you would have seen a bit of success, but then price would have come back down again, okay? But you're saying to yourself that you're going to wait 2 to 3 days for this move to play out or not. So price could actually move against you. How much is that move costing you? How are you feeling mentally about the deviation? Are you just accepting that, okay, Bitcoin, as long as it doesn't come down to this point, I'm okay? I mean, quite frankly, as a swing trader, that is quite far. Okay, from 30,000, say from 30,200 all the way down to 28,785, that's nearly a $2,000 move. Okay, that's quite a bit of, that's quite a bit of leeway to give a move. But if you are risking an amount of liquidity where it doesn't actually hurt your balance, and in other words, if you're able to recuperate from a loss from a $2,000 drop in Bitcoin, can you recover from that? Then you are using the right risk management. You see, if you're not going to lose a lot of money if Bitcoin drops 2K, you're not also going to make a lot of money if it rises 2K. And you have to be okay with that, because the idea is that you stay in the game. How often are you going to apply this? In a book called Day One Trader, there was a gentleman, and he always used to take the piss out of him because he was, the Market Wizards, that's it. The book called Market Wizards. And it was the greatest stock traders and forex traders in all time. And there was a gentleman in there called, he was referred to as One Lot, okay? And this guy was trading in the pits, and there were guys around him that were using 10,000 lots, 100,000 lots, mad sizes, okay? Yet this guy was using 1 lots all the time. And people were like, what the hell are you doing here, man? How are you going to make your money? And he's like, I'm about consistency. I'm all about consistency. When the markets came to shit, okay, Mr. One Lot was the only person that was profitable. He was the only one who was up when the markets come crashing down. You see, he was using a certain amount of risk that was comfortable for him to be able to make decisions not based on how much money he was losing or making, but based on how price was behaving. And that's what's going to help you guys in your trading. If you're able to come to the chart and make your decisions solely off the way the price is moving, the way the candlesticks operate, okay, you're going to be very reluctant to be making a trade solely off the idea that you can't handle a drop of $1,000 to $2,000 in Bitcoin because it will hurt your balance. Okay? So when you next time come to the charts and you are working out what time frame I should use to factor in what risk I should use, well, let's look at it like this. Go to the 1 minute time frame, okay? The 1 minute time frame, ladies and gentlemen, is a very fast time frame, okay? 90% of your risk management in the 1 minute time frame has to be take no shit when you are risking money. You have to cut and you have to change direction. You have to be in the zone to be trading the 1 minute time frame. Okay? If you catch or set yourself a strategy where you want to play the deviations away from the moving average, okay? You have to factor in the costs of doing your trade and the move to cover that cost. And that is kind of hard, ladies and gentlemen. Which is why when you want to trade those sort of situations where you're using high leverage and low capital, okay, you want to make sure that you see aggressive moves in the 1 minute time frame before you start taking trades. This is what you don't want. You don't want this bullshit. That's terrible. What you want is this right here. You need these plays, these drops, and these retraces back up. Okay, if you see these continuous moves to the downside, okay, you look left and understand if they've been marking up price to the upside for quite some time, you're going to get yourself ready and assume that, okay, it's going to come back down. What risk factor do I need to put in? Well, this is where it comes in with risk management. Okay, if you're going to take the trade on the short in this area here, you need to say to yourself, I am okay with risking X amount of liquidity, and if price goes beyond this point, I am out. I have no questions asked. I don't care. I am out of the trade. If price breaks this point, I am out, and I have to be okay with that. Mathematically, this might be 5%, 10%, 20% for those super risk averse people. Okay? You have to be okay. But at the same time, you cannot be disheartened if it goes against you and it does take a chunk of your account, because you had the decision in the first place. You were given the option to use a less amount of money. And the reason why people lose in trading, especially on smaller time frames, is because they are not aligned with what could happen if it goes against them. All they're focusing on is, if the chart shows me that price has deviated away from a moving average, or it has aggressively been moving up, it has to come down. No, it doesn't. We had a pair of kings, ladies and gentlemen, pre-flop. The guy betted aggressively into me, told me he had a good hand. I called it with the best hand, and the flop came out and it was brilliant for me. Then the turn, then the river, and then we split the pot. I had the best hand. You can have the best setup. But if your relationship to risk is not aligned with the way that you trade, you will always struggle to manage your risk because it's not aligned with the way you trade. If you're not that person that likes to spend money, then naturally your risk is going to be very, very tight. But the same token, you may not give yourself a chance if your risk is too tight because you are trading a volatile asset. There will never be one stop. There will never be a whole approach for you to apply risk. Okay, risk is a structure, but risk is all about personality, which is why I say to you, the one thing that we can all relate with when it comes to trading is to try and stay in the game. How well do you survive in the realm of uncertainty? If you walk into a wooded area and you can't see anything and it's pitch black, what is it that kicks in? Your instincts, adrenaline. If you're holding on to a trade, okay, that is going against you and you're waiting for it to just make that move into your entry point so you can realize a profit, what are you feeling at that point in time? If you know exactly where you're going to lose the right amount of liquidity, why are you feeling concerned about it hitting it? If you've absorbed the idea of how much you can lose, why are you allowing yourself to be fearful of something that hasn't actually happened yet? Why are you allowing yourself to think of the scenario of it actually happening against you? How are you going to be adapting to the way the chart is playing out if you're focusing on a result that hasn't happened yet? If you go short from this area here, ladies and gentlemen, and your risk is up here, why are you focusing on what would it look like if price was to go against me? Why would you pull out a calculator and say to yourself, right, okay, if I risk this amount of money, that means I'm going to lose $1,000 on 10 grand. That means I've only got $9,000 left. Well, what do I need to see? Oh man, is it going to work? What if it goes up here? I mean, how would it be if I just took $500 loss? Maybe I might be okay with that. But then what if it goes against me? And then what if it actually goes in my favor? If I close at $500, I'm going to leave it there. But what if it hits me, man? I don't want to lose, man. I was losing last week, man. I can't take it anymore, man. Just fucking go down, Bitcoin. Go down. Everything is stacked in my favor. Why is it not going down? Now, you can be that trader that says, you know what? I'm going to wait for a short in this zone. Okay? Given that Bitcoin has aggressively moved to the upside, I'm going to set my stop so that it can't go to a point in the chart where if it does decide to go to that point, it will be a complete surprise. Then I'll know that I'm wrong. So then you say to yourself, okay, what does 2% look like on my account? Are you cool with that? If I have an entry of a short right here and price goes all the way up towards the 31,100 zone, am I cool with that? Well, how much is that? So from this entry point right here, all the way up to the 31,200 point, that's $1,061. Can Bitcoin move $1,061 after it has moved already aggressively to the upside? What you've got to do, guys, is this. The sweet spot to working out the way you can exploit price action is this. Let me bring this up for you. Okay. Watch this. Here is an example of this trade that I did. Okay, earlier in the week. All right. I had seen an aggressive move in Bitcoin to the downside. Yeah? But I also had this aggressive move to the upside as well. I saw the vector candles over here. When I opened the trade itself, I didn't have this. Remember, this is where my entry was. I didn't know there were vectors. That's where I was looking. That's my entry. Okay? I looked left and I could see that there was price action for me to exploit. I had experienced the drop to the downside and they didn't follow through with it. Price started making its way into the moving average. I'm looking left and assuming that, yes, this could be a point in the chart that Bitcoin continues higher. At that point in time, I believe that that is where Bitcoin was going to move. Okay? And it did. I could have closed at a profit up here, but then price came automatically back down again. I added to my trade. What was my structure? Well, look, that's my structural point right here, because Bitcoin could come down into that point. And if it does go down into that point, I'm out of my trade. And if it does decide to bounce up, it doesn't matter, because at that point in time, if it does make its way down there, I could be waiting for it to come down and hit this previous liquidity point right here, and I could be even in a worse situation. I could change direction and run price to the downside right there, fine. But my relationship with risk said to me, okay, I've seen a push up. They're going to start going back up again. They're going to do it again because they know that they can trigger interest in this zone. That's why I went long again in here. And then we closed at this point right here. My deviation was very minimal. Price from this point, 1, 2, 3, 4 points right here was very small. Probably a $10, $15 exposure. Okay? Then I had a little bit more exposure right here. They bounced away from it. So in my eyes, I was favoring higher prices. But realistically, I never knew it was going to do this. All I did was I said, I favor higher prices. I'm putting the probability in my favor and assuming that this is where it's going to move. And I paid to play because there's nothing else that I can control other than how much time I want to be in a losing trade for and how long is it going to be before I decide to pay myself. I could have paid myself up here, ladies and gentlemen. But instead I added to my position. Now I've added to my position, I've got more money. I've earned myself more. I've managed to get in a fill at a lower price. Happy days. Did I know that it was going to come back down? No. But when price came back down, I wasn't losing my mind. Because if it was going to go down, it would need to break beyond this structure here. So I don't need to be thinking about this structure until it starts making its way towards it. If I was to lose at this point right here, I may have lost myself about 3-4 grand. Fine. I'm cool with that. It doesn't matter to me. Why? Because I knew how much I would lose and I was okay with it. So then what I needed to do in this instance was say to myself, okay, how uncomfortable am I going to allow myself to get to know that I'm wrong? Because at that point in time, you have nothing else but what price is doing. So where does risk management come into it? Where does the math come into it? The only math that you need to keep in your minds is, how bad is the loss going to be to my account? How hard do I have to work now to recover that loss? How deflated am I going to feel if the loss does go against me, if the trade goes against me? Which takes me back again, ladies and gentlemen, to the idea that in trading, there is no one-all plan for you to apply, which is going to guarantee that you're going to see success in trading. Again, survival is the only thing that's going to work for you in trading. The survival instinct is what's going to save your trading. The math, okay, that makes sense, okay? It does make sense, but realistically, money management is useless if you don't have mind management. How are you going to be in a position to manage your exposure if you don't have the mindset behind you to allow the exposure process to play out? We know there's going to be drawdowns. We know that there's going to be variance. We know that price will, the confluences that we look at in the charts, and if they all add together, we know that they could all come to loss. We know this, which is why the takeaway for you from this video, ladies and gentlemen, if you are going to try and come to the charts and say to yourself, you know what? I cannot control how I feel about a losing trade, because naturally you feel like shit. You don't want to lose money. I get that. So you have to be in acceptance of it. You can't change your basic human nature. But what you can do, okay, is to improve the chances of you not losing your mind when you take a loss. You use a certain amount of liquidity that suits your personality. If you're trying to make money, stop. Try to execute the trade correctly. Stop focusing on money whilst trying to make money at the same time is probably one of the most difficult things to do when it comes to this game in trading. I promise you, it's hard. Because the end result is to make money. And then when you start losing money all the time, you start to feel like shit. And then you need to come away from trading so that you can come back into the fray. All I can say to you, ladies and gentlemen, is this. Whether you risk 1%, 2%, 3%, 4%, ultimately, how do you respond to the loss, which is going to reflect whether or not you can allow yourself to accept it. If you can't accept 1% loss, then you have to go lower. If you can accept 4% loss, then you have to be very sure that your trades, your execution is optimal. So how do you practice that? You start using small amounts. Again, come away from the idea of making money. I don't want you to make money. I want you to execute trades. How does that make sense, Tino? How on earth does it make sense? You're telling me you don't want me to make money. You want me to focus on the execution of trades. So when do I make money? Well, hold on a second, bro. The execution of the trade being correct implies that you are going to make money. So I don't need to worry about making money. I need to worry about the execution. My execution and the amount of money that I decide to risk need to join together so that it fits my personality and the way I have an understanding of risk. Do you want to lose $200 on your account? Or do you want to go and spend $200 on shoes? Which one's better for you? Which one are you used to doing? Are you cool with just spending money for some pair of shoes? Are you cool with going out and spending $300 on a night out? Are you cool with $200 loss? Are you cool with $300 loss? Until you marry your mind of acceptance in loss to trading and not compare it to your everyday life, because every day your life is different to the trading life. You can't put money into trading. You can't risk money in trading and expect a return. That's not how it works. It's not tit for tat. There will always be the idea that whatever money that you risk could go. And the takeaway for you again, ladies and gentlemen, is to not be results-based orientated, to approach things in terms of a process. If risk is an issue for you, okay, what you really need to do is you need to get comfortable with having trades on that don't require you to pay attention to them. Okay? In my opinion, the best way for you to understand if you're using too much risk is if you can open a trade and come away from the screen, go to bed, continue about your day, and log into your charts on the whim to see that your trade is still open and you ain't even lost that much money. The day you stop caring about loss, okay, is the day you start winning. Because it's when you start caring too much about loss, which is where you then start opening trades, quickly taking profits and not allowing yourself to win. And you start allowing yourself to take bigger losses. It's madness, isn't it? We don't pay ourselves when we get a chance to. We don't cut the trade at a small loss. But we will cut the trade at a big loss. Why? You look at a $100 loss and you say, fuck, that's only $100. You look at a $2,000 loss and you say, fuck me, that's a lot. Why did you have to wait for it to go to 2,000? Why didn't you close it at 100? Why are you comfortable losing 2K as opposed to 1? Ultimately, you're losing. So get used to losing small. Remember, guys, as short-term day traders, it's all about survival. I hope this has served. Mad love and respect. Peace.